The raw data for the first quarter of 2026 shows a network at full capacity. We're looking at 200 million transactions and a record $180 billion in stablecoin supply moving across the Ethereum ecosystem. This split-screen chart reveals the central conflict. On the left, network activity is spiking, but on the right, the spot price is completely disconnected, grinding down 50% from its 2025 highs to settle into a flat baseline at $2,300. Retail sentiment is currently defined by fear. As the price stays flat, capital is rotating out of this baseline and into smaller, more volatile assets. For an observer, this creates a dilemma. Is this technical weakness a signal for a bearish swing trade, or is the flatline a mask for a massive institutional accumulation phase? Reading this wrong is expensive. If you short the bottom of an institutional pivot, you risk liquidation. But if you buy in too early, your cackle could sit stagnant for months while the rest of the market moves. To find the correct entry, we have to separate the temporary architectural flaws in Ethereum's tokenomics from the long-term catalysts building in the background. Navigating this divergence requires moving past retail sentiment and parsing the data based on your specific time horizon. The current price suppression is a direct result of the March 2024 Dencun upgrade, an architectural shift that prioritized network scaling over immediate asset scarcity. Dencun successfully cut Layer 2 data costs by 95% to attract new users. However, that efficiency decimated base layer fee revenue by 99%. Without high fees burning supply, Ethereum reversed into a mild 0.8% inflation rate. Overlaying the spot price on this rising supply curve makes the lack of momentum clear. Continuous new supply acts as a weight on the market. This translates into clear technical boundaries. Specifically, the 100-day exponential moving average at $2,388 is currently a heavy ceiling preventing any upward breakout. With a negative daily MAC day and failed attempts to cross that 100-day average, short sellers maintain the immediate mathematical advantage on this chart. However, the daily RSI sits at 26.5, representing deeply oversold conditions. This suggests the current downward selling pressure is nearly exhausted. That exhaustion is hitting just as we approach the Glamsterdam protocol upgrade in the first half of 2026. Glamsterdam introduces parallel transaction processing to handle up to 10,000 transactions per second. This massive volume spike is engineered to reignite the deflationary burn mechanism, directly addressing the supply issue. The bears have a valid argument today, but their window of opportunity is closing as the protocol nears these deflationary updates. Regulatory shifts over the past 36 hours are also beginning to tighten the supply matrix. The SEC officially approved options trading on spot Ethereum ETFs. This invites institutional hedging and delta-neutral strategies, providing the liquidity needed to dampen downside volatility. Meanwhile, the agency delayed decisions on allowing these ETFs to stake their holdings. This delay creates a temporary artificial pool of liquid supply. Staking requires locking Ethereum in a contract to secure the network in exchange for programmatic yield. Exactly 32.26% of Ethereum's supply, over $91 billion, is already locked in staking contracts. Meanwhile, billions in US ETF holdings sit idle due to SEC delays. Once approved, asset managers will lock this supply for yield, instantly evaporating remaining liquid supply. This delay provides an accumulation window. Once those billions are locked, the resulting supply shock will likely lead to an aggressive repricing. Beyond the retail charts, the core utility of the network is being cemented by Tier 1 financial institutions migrating to Ethereum-compatible architecture. This is most evident in the overnight repurchase market, the $12.6 trillion daily heartbeat of the global financial system. Legacy repo systems are prone to settlement delays and counterparty risk, resulting in nearly $1 trillion in losses over the last decade. JPMorgan Chase is now bypassing those legacy rails, settling $350 billion in repos daily on EVM-compatible infrastructure to eliminate those specific risks. Using blockchain allows for atomic settlement, the simultaneous exchange of cash and collateral. It destroys information asymmetry and lets capital move 24/7 without weekend freezes. Corporate treasuries have already acquired 3.8% of the total Ethereum supply to run these back-end operations. This operational reliance attaches Ethereum's baseline value to the functional needs of global banking, detaching it from retail sentiment cycles. The data reveals a clear split. Short-term tokenomic inflation and technical resistance are currently masking a massive trillion-dollar institutional integration. Selecting the right strategy requires you to choose a path based on your primary trading horizon. In the short term, under 3 months, the bearish view is mathematically supported. You must respect the 100-day EMA resistance and the current lack of upward momentum. But shorting here is a game of chicken playing against the clock, vulnerable to a sudden SEC approval or Glamsterdam squeeze. For a horizon of 6 to 12 months, the data favors spot accumulation in the $2,100 to $2,300 zone. The trade-off for long-term holders is time. You must accept capital stagnation today in exchange for the supply constraints and scaling upgrades arriving in the coming months. This sideways market offers a window to acquire a foundational settlement layer at a discount to its current network usage, provided you have the patience to outlast the short-term algorithmic bears.